You spend 40 years contributing to your 401k. You watch the balance grow 200,000, 400,000. Maybe you get to a million if you started early and the market cooperated. You see that number on your statement and think that's your retirement, your security, your reward for decades of work and discipline. But here's what your financial advisor never told you: that money isn't actually yours. It never was. It's in a government design trap that was built into the system from the beginning. And when the next crisis hits, when the government needs assets to prevent economic collapse, your 401k will be nationalized, not confiscated. Nationalized. They'll let you keep a claim. They'll promise you income. They'll say they're protecting your retirement, but the assets will belong to the Treasury, converted to government bonds, locked away, inaccessible, and irreversible. This isn't speculation. The legal framework already exists. The proposals have been drafted, the precedents have been established, and the timeline is shorter than most people realize. Because the government doesn't need to pass new laws, they just need a crisis big enough to justify activating the emergency provisions already buried in the tax code and ERISA regulations. And that crisis is being engineered right now through monetary policy that guarantees a debt spiral and pension collapse. The trap is set, your money is the bait, and 2027 is when the trap springs shut. Let me show you something most people have never seen. It's called the Automatic IRA Act, introduced in Congress multiple times over the past 15 years, never quite passes, never quite dies, just keeps coming back in slightly different forms. The most recent version was introduced in 2023 bipartisan support, backed by the Treasury Department, framed as helping workers save for retirement, making retirement savings automatic. Sounds helpful. Sounds responsible. But read the actual text of the bill and you'll find something disturbing. The automatic contributions don't just go into any retirement account. They go into government-managed accounts, specifically accounts that invest primarily in Treasury securities, government bonds, your retirement savings automatically flowing into government debt. This is the nationalization mechanism, and it's waiting for the crisis that makes it mandatory. But before we get to what's coming, you need to understand what already happened, because the 401k system was designed as a trap from the very beginning. It just took 40 years for most people to walk into it. The 401k was created in 1978 through a provision in the Revenue Act, Section 401k of the Internal Revenue Code. It was supposed to be a small tax benefit for corporate executives, a way to defer compensation. But in 1981, the IRS issued regulations that allowed rank-and-file employees to participate. And corporations immediately realized they'd been handed an escape hatch from pension obligations. Before the 401k, most workers had defined benefit pensions. The company promised you a specific monthly payment in retirement. The company bore the investment risk. The company was responsible for making sure the money was there when you retired. But pensions were expensive, required companies to maintain large reserves, created long-term liabilities on balance sheets. The 401k changed everything. Now the company could contribute to your retirement but shift all the investment risk to you. If the market crashed right before you retired, that was your problem. The company's obligation ended with the contribution. No long-term liability, no pension obligation, just a matching contribution and a tax benefit. Within 20 years, pensions were virtually extinct in the private sector, replaced entirely by 401ks. Workers thought they were getting the same benefit. They weren't. They were getting shifted risk and a tax deferral, not ownership. Because here's the thing about 401ks that nobody explains. The money isn't yours until you withdraw it. It's in a qualified retirement plan. subject to withdrawal restrictions, subject to required minimum distributions, subject to tax treatment determined by Congress, subject to regulations that can change at any time. You can't access it before 59 and a half without penalties. You must start withdrawing it at 73, and every withdrawal is taxed as ordinary income at whatever rate Congress decides. That's not ownership, that's conditional access to your own money. Now, add another layer. Your 401k is held by a custodian, usually a large financial institution, Fidelity, Vanguard, Charles Schwab. The assets are in your name, but they're in the custody of the institution. And if that institution fails, if there's a systemic crisis, those assets become part of the bankruptcy estate. You have a claim, but you don't have possession. We covered this in The Great Taking. The securities in your 401k are held through the DTC. You don't own them, you have an entitlement to them. And entitlements get subordinated in bankruptcy. The 401k structure makes you a creditor, not an owner. And creditors get wiped out when the system collapses. But it gets worse because there's a third layer. Your 401k contributions are tax deferred. You didn't pay taxes on that money when you earned it. You'll pay taxes when you withdraw it. That deferral is a tax benefit. But tax benefits are government subsidies, and the government tracks its subsidies, calls them tax expenditures. The largest tax expenditure in the entire federal budget, retirement account deferrals, over $200 billion per year in foregone tax revenue. That's how the government views your 401k, not as your property, as their deferred tax claim on income they haven't collected yet. And here's where it gets really interesting. That deferred tax claim gives the government a legal hook to impose conditions. Because if your 401k balance represents uncollected taxes, then the government has a legitimate interest in making sure that money is invested safely, prudently, in assets that preserve principal and guarantee returns, like Treasury bonds. See where this is going? The framework for nationalizing 401ks has been discussed in policy circles for over a decade. It's not a secret. It's not a conspiracy. It's openly debated in economic journals and Treasury Department white papers. The most explicit proposal came in 2008, right after the financial crisis, when millions of Americans saw their 401k balances collapse by 40 or 50%, when retirement accounts lost $2 trillion in 6 months, when panic was at its peak. At that moment, several Democratic members of Congress and union-backed think tanks proposed something radical: eliminate the 401k system entirely, replace it with government-guaranteed retirement accounts. Everyone gets an account. The government contributes a base amount. Employers contribute. Employees contribute. But the assets are managed by the federal government, invested in a diversified portfolio that includes a significant allocation to Treasury securities. And in exchange for accepting government management, you get a guaranteed minimum return, 3% per year, guaranteed by the full faith and credit of the United States government. Sounds good, right? Guaranteed returns, no market risk, professional management. What could go wrong? Here's what. The guarantee only works if the government can actually pay it. And the government can only pay it by either raising taxes dramatically or printing money. And printing money causes inflation, which erodes the real value of your guaranteed return. A guaranteed 3% when inflation is 7% means you're losing 4% per year in purchasing power. The guarantee is worthless. But more importantly, once your retirement assets are in government-managed accounts, they're no longer yours in any meaningful sense. They're government liabilities, claims against future tax revenue. And when the government faces a fiscal crisis, when debt becomes unsustainable, when bondholders demand payment, the government will do what it always does: restructure, extend maturities, reduce payments, impose haircuts, and your guaranteed retirement account will be part of that restructuring. Your 3% becomes 2%, then 1%, then the payments get deferred. Then they get converted to long-term bonds that mature after you're dead. Um, the guarantee evaporates, and there's nothing you can do because you don't own assets. You own a claim, and claims get restructured in bankruptcy. The 2008 proposal didn't pass. The backlash was too strong. People recognized it as confiscation disguised as protection. So the proponents changed tactics. Instead of eliminating 401ks immediately, they'd transition gradually, make participation in government managed accounts voluntary at first. Incentivize adoption with bonuses and tax benefits, then make it mandatory for new workers, then expand it to existing accounts. The boiling frog approach. Each step seems reasonable. Each step is small enough to avoid mass resistance. But the end result is identical. Government control of retirement assets. This is exactly what's happening now. The automatic IRA proposals, the Secure Act provisions, the retirement security task forces, all of them pushing the same direction: more government involvement, more mandatory contributions, more restrictions on how retirement assets can be invested, more requirements to hold safe assets like Treasury bonds, and more integration between private retirement accounts and Social Security. The systems are being merged, not all at once, step by step, and each step reduces your control and increases government access. Let me show you the timeline, because understanding the stages tells you when the final transition happens. Stage 1 was creating the 401k system and shifting retirement risk from companies to individuals. This happened between 1978 and 2000. Pensions disappeared, 401ks became universal. Workers thought they were building wealth. They were actually building a pool of assets that the government could access later. Stage 1 is complete. Stage 2 was regulatory capture, making 401ks so heavily regulated that they're effectively government controlled, even though they're privately held. This happened between 2000 and 2020. ERISA regulations expanding, fiduciary requirements increasing, investment options restricted, mandatory disclosures, required distributions, penalty taxes. Every aspect of your 401k is governed by federal law. You can't access it freely, can't invest it freely, can't pass it to heirs freely. The regulations have turned your account into a government-controlled entity that happens to have your name on it. Stage 2 is complete. Stage 3 is creating the parallel system, government-managed retirement accounts that exist alongside 401ks. This is happening now in 2025. The MyRA program was the first attempt, launched by Obama in 2000, discontinued in 2017 due to low adoption. But the infrastructure remains. The Treasury Department still has the technical capability to create government-managed accounts. They just need the political will and the crisis justification. Current proposals are more sophisticated: automatic enrollment, employer mandates, tax incentives for participation, the carrot approach. Stage 3 is underway. Stage 4 will be mandatory participation for certain workers, new workers, gig workers, self-employed, anyone who doesn't have access to an employer-sponsored plan. The government will say they're being excluded from retirement security. The government will offer a solution: automatic government-managed accounts. You can opt out, but you'll lose tax benefits. You'll pay higher Social Security taxes. You'll face penalties. So most people won't opt out. They'll take the government account, and once enough people are in the system, once it's normalized, the pressure to expand it to all workers becomes irresistible. Stage 4 is being prepared now through legislative proposals. It will activate during the next recession. Stage 5 will be the crisis conversion. This is where existing 401ks get converted to government management. Not immediately, not through confiscation, through a restructuring offer during a crisis. The crisis will be a market crash, a bond market collapse, a pension system failure, something that causes massive losses in retirement accounts. Millions of Americans watching their 401ks drop by 60 or 70%, panic in the streets. Political pressure for action, and the government will offer a solution. Convert your 401k to a government guaranteed account. We'll stop the bleeding. We'll guarantee your balance at current levels. We'll ensure you have retirement income. All you have to do is transfer your assets to government management. Most people will accept because they're terrified, because they've lost half their retirement savings, because the government guarantee sounds like salvation. They won't realize that the guarantee is a trap, that the assets they transfer become government property, that the income they're promised depends on the government's ability to pay, that they've just traded market risk for sovereign risk. And sovereign risk is far more dangerous because you can't diversify away from your own government. When it fails, you're wiped out completely. Stage 6 will be mandatory conversion. After enough people voluntarily convert, after the system is operating, after the precedent is set, the government will make it mandatory. All remaining 401ks must convert to government-managed accounts within a specified time frame. The justification will be systemic risk, financial stability, national emergency, whatever crisis is current. The conversion will be framed as protecting retirement security, ensuring everyone has guaranteed income, preventing future market crashes from devastating retirees, and opposition will be labeled as selfish, as putting individual interests above collective welfare, as undermining financial stability. The pressure will be enormous. The timeline will be short. And most people will comply because the alternative is having their retirement savings trapped in a collapsing private system. We're currently between stage 3 and stage 4. The infrastructure for government-managed accounts exists. The legislative proposals are circulating. The advocacy campaigns are running. The transition to stage 4 requires a catalyst, a recession, a crisis, a shock that makes workers desperate for retirement security and willing to accept government solutions. And that catalyst is being manufactured right now through unsustainable monetary policy. The Federal Reserve has expanded its balance sheet to $9 trillion. Printed trillions to buy government bonds, kept interest rates artificially low for over a decade. This created the everything bubble. Stocks inflated, bonds inflated, real estate inflated. All assets priced as if low rates are permanent. But they're not permanent. They can't be, because inflation forces the Fed to raise rates. And when rates rise, asset prices collapse, the bubble pops, and the 401ks holding those inflated assets lose 40 or 50%. That's the crisis that triggers stage 4 and stage 5. The timing matters. The Fed started raising rates in 2, markets declined, then stabilized. But the underlying problems haven't been solved. Government debt is still growing. Deficits are still massive. The debt service costs are now over $1 trillion per year. That's more than defense spending. The situation is unsustainable. Something has to break. And when it breaks, when the bond market collapses or the dollar loses reserve status or the debt spiral becomes obvious to everyone, the retirement accounts will be the pressure point, because $22 trillion in 401ks and IRAs represents the largest pool of private assets in the country. and the government will need those assets to survive. Let me be explicit about how the nationalization will work, because it won't be called nationalization. It will be called the Retirement Security Act or the Pension Protection Program or some other Orwellian title that sounds like help. The legislation will be passed during a crisis. Emergency provisions, bipartisan support, everyone agrees something must be done. The law will create a new government entity, the Federal Retirement Administration, or the National Pension Board, doesn't matter what it's called. This entity will manage all retirement accounts. Existing 401k balances will be converted to FRA accounts. You'll receive account credits equal to your current balance. But the actual assets, the stocks and bonds in your 401k, will be transferred to the FRA. The FRA will invest those assets in a portfolio determined by Congress and Treasury. That portfolio will be heavily weighted toward Treasury bonds, 70%, 80%, maybe more, because the government needs to finance its debt. And your retirement assets are the perfect captive buyer. You'll be told this is for your protection. Treasury bonds are safe, government guaranteed, no market risk. But here's what they won't tell you. When the government is the issuer and the buyer and the guarantor, the whole system is circular. The government borrows money by selling bonds to your retirement account, then promises to pay you back by collecting taxes. But if the economy collapses, if tax revenues fall, if the debt becomes unpayable, the government won't have the money. They'll print it, which causes inflation, which destroys the real value of your account. You'll have nominal balance. Numbers on a screen, but the purchasing power will be gone. This is what happened to Social Security. You pay in for decades. The government promises benefits, but the benefits are paid in inflating dollars. $1,000 in Social Security today buys a fraction of what $1,000 bought in 1970. The value is eroded through inflation. The promise is technically kept while being practically broken. The same will happen to Nationalize 401ks. You'll get your guaranteed payments, but the payments won't be enough to live on, and you'll have no recourse because you don't own assets anymore. You own a claim against a bankrupt government. Now let's talk about precedent, because the government has confiscated private assets during emergencies multiple times in American history. And every time it was framed as temporary, as necessary, as protecting the public interest. And every time the confiscation became permanent. Executive Order 6102, gold confiscation. We covered this earlier, but it's worth repeating because it's the perfect parallel. The government forced citizens to turn in their gold, paid them $20 per ounce, then immediately revalued gold to $35. The government stole 40% of the value, called it monetary policy, and it lasted 41 years. Your 401k will be confiscated using the same playbook: crisis justification, mandatory conversion, immediate restructuring, permanent control. Iran hostage crisis. Carter administration froze all Iranian assets in U.S. banks, private assets, not just government accounts. Private citizens who happened to be Iranian had their bank accounts seized. No trial, no compensation, just emergency executive action. The precedent was set. The government can freeze private assets during emergencies. Your 401k is a private asset, and when the emergency comes, when the crisis hits, the government will invoke the same authority. Cyprus banking crisis. The government of Cyprus, with approval from the EU, confiscated deposits from bank accounts to bail out failing banks, called it a bail-in, took money directly from depositors. People who thought their savings were safe discovered they were collateral. The U.S. has adopted similar bail-in provisions through Dodd-Frank. Your retirement account could be subject to bail-in if the financial system collapses, not theft. Resolution, not confiscation, restructuring. But the outcome is identical. Your assets are taken, your savings are gone. These aren't historical curiosities, they're operational precedents, legal frameworks that can be activated during the next crisis, and your 401k is the largest pool of assets available for confiscation, $22 trillion. More than enough to fund government operations for years, more than enough to pay bondholders, more than enough to prevent immediate collapse. The temptation is irresistible, and the legal mechanisms are already in place. So what do? If the trap is set, if the crisis is coming, if the nationalization is inevitable, what's your move? Because waiting until stage 5 is too late. Once the crisis hits, once the conversion is announced, you'll have weeks or months to move assets, and the restrictions will be immediate. Early withdrawal penalties will increase. Tax consequences will be devastating. Capital controls might prevent large transfers. The window to act is before the crisis, before the panic, before the trap closes. First, understand the limitations of 401k protection. You cannot withdraw your entire balance without massive penalties and taxes. If you're under 59 and a half, you'll pay a 10% early withdrawal penalty plus ordinary income tax. Could be 40 or 50% total. That's not a solution. That's destroying wealth to escape. But you can make strategic moves within the rules. If you're over 59 and a half, you can withdraw without penalty. Consider taking distributions out, pay the taxes at current rates, move the money to assets outside the retirement system. Real estate, precious metals, foreign assets, anything that isn't subject to U.S. government control. Yes, you'll pay taxes, but you'll pay them at today's rates. When the crisis hits, when the government is desperate, tax rates will explode. Better to pay 30% now than 70% later. If you're still working, stop contributing to your 401k. I know that sounds insane. You're giving up the employer match. You're giving up the tax benefit, but you're also refusing to put more assets into the trap. The employer match is bait. The tax benefit is deferred taxes, not eliminated taxes. And when your 401k gets nationalized, both the match and the tax benefit become irrelevant. You'll lose the principal. Better to pay taxes now and invest in assets you control. Consider Roth conversions. Convert your traditional 401k or IRA to a Roth IRA. You'll pay taxes on the conversion. But Roth accounts have different legal treatment. They're after-tax accounts. The government can't claim their deferred tax revenue. The legal hook for nationalization is weaker, not eliminated, but weaker. And in a crisis, weaker might be enough to create an exemption or delay. Plus, Roth distributions are tax-free, so even if the account gets nationalized, the conversion protects you from future tax increases. Self-directed IRAs offer more flexibility. These are retirement accounts where you control the investments. You can hold real estate, precious metals, private company shares, foreign assets. The assets are still in a retirement account for tax purposes, but they're outside the traditional financial system. Harder to seize, harder to nationalize, more complicated to integrate into government management. Not bulletproof, but more resilient than a standard 401k at Fidelity. Physical assets are the strongest protection. Gold and silver held personally. Real estate titled in your name. Equipment, vehicles, collectibles, assets that exist outside the financial system entirely. Can't be nationalized through electronic transfer. Can't be frozen with a database update, require physical confiscation, which is possible but difficult to scale. Throughout history, the assets that survived government confiscation were physical assets that could be hidden or moved. Paper assets get seized, digital assets get frozen. Real assets have to be found and taken. That creates friction, and friction is protection. Foreign accounts create jurisdictional barriers. If your assets are in a foreign country outside U.S. banking system, they're harder to seize. Not impossible. The U.S. has long reach through FATCA and international agreements, but harder, slower, requires more effort. And in a crisis, the government will take the easy targets first. Being a hard target might buy you time, might buy you exemption, might buy you negotiating leverage. But here's the reality. Most people won't act. Most people will keep contributing to their 401k, will believe the retirement account is safe, will trust that the government won't really confiscate private savings, will convince themselves it's paranoia, and they'll be the ones standing in line at the Federal Retirement Administration office trying to figure out why their account balance is 50% of what it was, and why they can't access their money, and why the guaranteed payments aren't enough to cover rent. The 401k trap was built deliberately. 40 years of encouraging workers to put their savings into accounts they don't really control. 40 years of tax incentives that made it irrational not to participate. 40 years of building a pool of assets large enough to solve the government's fiscal crisis. $22 trillion. All of it accessible through emergency provisions already written into law. All of it waiting for the crisis that makes confiscation seem like salvation. That crisis is coming. The debt is unsustainable. The unfunded liabilities are unpayable. The fiscal trajectory guarantees collapse, and when it comes, when the bond market breaks, or the dollar fails, or the debt spiral becomes obvious, the government will need assets. Your 401k is the largest pool of assets available, and the legal framework to take it is already in place, not through theft, through mandatory conversion to government-managed accounts for your protection, for retirement security, for the greater good. 2027 is the timeline because that's when the fiscal crisis becomes unavoidable. That's when Social Security starts running massive deficits. That's when Medicare costs explode. That's when debt service exceeds all discretionary spending. That's when the government faces a choice. Default on debt, print money, and cause hyperinflation, or seize private assets to fund operations. They'll choose seizure, call it nationalization, call it retirement security, call it whatever makes it palatable. But the function is confiscation. You have been warned. You have been shown the mechanism. You have been given the timeline. What you do with that information determines whether you retire with assets you control or with a claim against a bankrupt government. The trap is set. Your 401k is bait, and the government is waiting for the crisis that makes springing the trap seem like rescue. That crisis is coming, and it's coming sooner than you think. Now let's talk about something your employer never explained when they enrolled you in the 401k. The matching contribution. You thought it was free money, a benefit. Your employer puts in 3% if you put in 3%. Sounds generous, but read the fine print. That match isn't yours immediately. It vests over time. usually 3 to 6 years, which means if you leave the company before the vesting period completes, you forfeit the match. The employer gets it back. But here's the part nobody discusses. Even after it vests, even after it's legally yours, that matched money came with strings attached, strings that give your employer and the government leverage over those funds. The matching contributions are tax deductible for the employer, which means the government subsidized your employer's contribution through tax policy. And subsidies come with conditions. Your employer had to set up the 401k according to ERISA regulations, had to use approved custodians, had to offer approved investment options, had to follow government mandates on contribution limits, distribution rules, and reporting requirements. The match wasn't generosity, it was compliance with a government program designed to aggregate private savings into a controllable system. And here's where it gets interesting. Your employer doesn't actually control the 401k assets. The plan trustee does, usually a large financial institution, and the trustee has fiduciary obligations, not to you, but to the plan. The plan is a legal entity, a trust. You're a beneficiary of the trust. But beneficiaries don't control the assets. Trustees do. And trustees follow regulations, and regulations can change overnight during an emergency. Let me show you the specific regulatory hook that enables nationalization. It's called Prohibited Transaction Rules under ERISA Section 406. These rules govern what 401k plans can and cannot invest in. Currently, plans have broad discretion. Stocks, bonds, mutual funds, target date funds. But the regulations also include a provision that allows the Department of Labor to designate certain investments as mandatory for prudent management. This provision has never been fully activated, but it exists. And during a crisis, during a market collapse, when millions of workers are losing their retirement savings, the DOL could issue an emergency regulation requiring all qualified retirement plans to hold a minimum percentage of assets in Treasury securities for safety, for stability, for protection. The regulation would be framed as preventing another 2008, protecting retirees from market volatility, ensuring retirement security through government-backed assets, and every 401k trustee in the country would be legally required to rebalance their plans into treasuries within 90 days. Your mutual funds sold, your stocks liquidated. The proceeds used to buy government bonds, you wouldn't be asked, you wouldn't be notified until after it happened. You'd just see your quarterly statement showing that your growth portfolio is now 80% Treasury bonds yielding 2%. While inflation runs at 7%, you're losing 5% per year. But it's safe and it's required by law. This isn't speculation. Argentina did exactly this in 2008. The government nationalized all private pension accounts. 10 years of worker contributions, approximately $30 billion, transferred to the government overnight. The official reason, the global financial crisis threatened the safety of private pensions. The government would manage the funds more prudently, guarantee payments, protect retirees. But the actual reason, the government was broke, couldn't make debt payments, needed assets, and the pension funds were available. The workers got promises. The government got cash. The promises were never fully kept. Poland did it in 2010. Nationalized 51% of all private pension assets, called it pension reform, said it was reducing government debt. The private accounts held government bonds. The government simply canceled the bonds and took the assets, reduced their debt by the amount they stole, and told workers their pensions were now government Social Security benefits, not private accounts, not property, just claims against future government revenues. When Poland eventually faces a fiscal crisis, those claims will be restructured, reduced, delayed, and the workers will have no recourse because they don't own assets anymore. Ireland did it differently, but with the same result. In 2011, the government mandated that all pension funds make a special contribution to a jobs stimulus program, not optional, mandatory. A tax on pension assets, called it a temporary measure. But temporary in government language means permanent. The contribution became an annual requirement, reducing pension balances every year to fund government programs. That's not nationalization through seizure. That's nationalization through taxation. But the outcome is identical. The assets leave the private account and go to the government. The United States has discussed all of these mechanisms. The prohibited transaction rules that force investment in treasuries, the special pension contribution tax, the mandatory conversion to government management. Every proposal has been floated. None has passed during normal times, but normal times are ending, and crisis times allow measures that would be politically impossible otherwise. Here's what most people don't understand about the 401k system. The assets are already segregated for government taking. They're in qualified accounts, separate from your regular savings, flagged in every database, easy to identify, easy to value, easy to transfer. The government doesn't have to search for your retirement savings. They know exactly where it is, exactly how much, and exactly how to access it. The 401k system created the most efficient confiscation infrastructure in history. All your retirement savings in one place. Registered with the IRS, tracked by your employer, held by custodians who follow federal regulations, and accessible through emergency provisions that require no congressional approval. Treasury already has the technical capability to convert 401k accounts to government management. They demonstrated this capability with the MyRA program. They built the systems, tested the infrastructure, ran the pilots. The program was discontinued due to low voluntary adoption, but the infrastructure remains. The database systems, the account management platform, the integration with IRS records, all of it sitting dormant, waiting for the crisis that makes it mandatory rather than voluntary. When that crisis comes, Treasury can convert accounts at a rate of millions per day. Your 401k balance transferred to a government account. Your investment choices eliminated, your control gone, and it happens automatically, electronically, irreversibly. The legal authority for this exists in multiple places. The Emergency Economic Stabilization Act of 2008 gave Treasury broad powers to take actions necessary to prevent financial collapse. The Dodd-Frank Act expanded resolution authority for systemic institutions. The Defense Production Act can be invoked for economic emergencies. The International Emergency Economic Powers Act allows the president to regulate financial transactions during national emergencies. Any of these statutes could be used to justify mandatory 401k conversion. The legal groundwork is complete. The only missing element is the crisis trigger, and the trigger is being engineered through debt accumulation. Federal debt is $35 trillion and growing by $2 trillion per year. Debt service costs exceed $1 trillion annually. Soon they'll exceed all discretionary spending combined. The math doesn't work. Something has to give. Either massive spending cuts that cause economic depression, or massive tax increases that destroy growth, or default that destroys the dollar, or seizure of private assets that postpones the reckoning. The political path of least resistance is asset seizure, especially if it's framed as protecting retirement security rather than confiscation. Think about the political dynamics. If the government announces they're nationalizing 401ks, there would be outrage, resistance, legal challenges. But if the government announces that market volatility threatens retirement savings and they're implementing emergency protections that guarantee your balance and provide secure income, most people will accept it, especially if the announcement comes during a market crash, when people are watching their balances drop by 50% in weeks, when panic is overwhelming rational analysis, when any guarantee sounds better than watching your retirement evaporate. The announcement will come on a Friday evening. After markets close, the president will address the nation, explain that extraordinary measures are necessary, that retirement savings are being protected through emergency regulations, that accounts will be converted to guaranteed income plans, that no one will lose their nominal balance, that payments will begin immediately. And by Monday morning, when markets reopen, the conversion will be complete. $22 trillion in private retirement savings transferred to government control, the largest asset seizure in human history, accomplished in 72 hours legally, peacefully, with majority public support. Because here's what most people will focus on: the guarantee. The government promises to pay, promises to provide income, promises to make you whole. And most people will believe the promise because they want to believe, because the alternative is accepting that their life savings are gone, that 40 years of work produced nothing, that they'll retire in poverty. The guarantee is psychologically necessary, even if it's economically impossible. Even if simple math shows the government can't keep the promise, people will believe because the truth is unbearable. But sophisticated investors know better. Know that government promises are only as good as the government's ability to pay. Know that when governments can't pay, they print money. Know that printing money causes inflation. Know that inflation destroys the real value of fixed payments. Know that a guaranteed income that loses half its purchasing power every 5 years is worthless. But sophisticated investors are the minority. The majority will accept the guarantee, will comply with the conversion, and by the time they realize the guarantee is hollow, it will be too late. The assets will be gone, converted to government bonds, locked away, and the slow destruction through inflation will begin. Your only protection is acting now, before the crisis, before the announcement, before the conversion, moving assets out of qualified accounts despite the tax consequences, because paying taxes at today's rates is better than losing the principal tomorrow, building wealth outside the retirement system, outside government control, in assets that can't be converted through electronic database updates, physical assets, foreign assets, assets that require physical seizure rather than digital transfer. These are harder targets, expensive targets, politically difficult targets. And when the government moves to nationalize retirement accounts, they'll take the easy path. The 401ks and IRAs that are already aggregated, already tracked, already accessible. If your wealth is somewhere else, you might escape. Not guaranteed, but possible. And possible is better than certain confiscation. The 401k trap is closing. The crisis is coming, the mechanism is ready, the timeline is short, and your window to escape is narrowing every day. By 2027, the fiscal mathematics become impossible to ignore. The crisis becomes unavoidable, and the government's need for assets becomes desperate. That's when the trap springs. That's when your retirement savings become government property. That's when the promises begin, and that's when the slow destruction starts. You were never meant to retire wealthy. The 401k system was never designed to build generational wealth. It was designed to aggregate assets for eventual government access, to shift risk from corporations to individuals, to create a captive buyer for government debt, and to ensure that when the fiscal crisis comes, when the government runs out of options, there's a pool of assets large enough to matter. Your assets, your retirement, your future. all sitting in accounts that were designed as traps from the beginning. The only question is whether you'll still be in the trap when it closes. The answer depends on the actions you take today, not tomorrow, not next year, today. Because tomorrow might be too late. The crisis might have started. The announcement might have been made. The conversion might be underway. And once it begins, there's no stopping it, no appealing it, no escaping it, just compliance and loss. The 401k trap is real. The nationalization is planned, the timeline is short, and your retirement is at stake.